Today, I want to talk about diversification. It's a big word and an important investment principle, but what does it actually mean to have a diversified portfolio? How do you diversify a portfolio, and why should you diversify a portfolio? In this short video, I will explain all of that. My name is Stephen Stricklin. I'm a certified financial planner and the president of Wise Wealth. I have helped many people plan for a peaceful and enjoyable retirement, and today I want to help you by talking about diversification. The technical definition of diversification is it's a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. Another way to look at diversification is that it is a strategy to reduce risk in a portfolio. The non-technical definition of diversification is to spread around. A phrase that relates is don't put all your eggs in one basket. But in order to understand diversification, you also have to understand different asset classes and asset types. Asset classes determines your asset allocation. Asset types determines diversification, and I'll explain the difference. Here are some examples of different types of asset classes. Let's say, for example, these apples right here represent stocks, and these oranges represent bonds, and then there's cash, and then there's real estate, and there's commodities, and there's all kinds of other asset classes that are out there. If you put all of your money into any one of these, you would not be diversified. So for example, if I had a basket or I just had a collection of stocks, this is only one asset class. This would not be a diversified portfolio. These are all apples in this one basket. But if I want to diversify a portfolio, that means I say, okay, I need some cash, I need some commodities, I need some stocks, I need some bonds, I need some real estate, I need some, other types of investments in here. And so that's how you diversify a portfolio. There are other ways to further diversify besides different asset classes. Asset classes, again, are stocks, bonds, cash, commodities, real estate, etc. But then the different asset types within those classes are in the world of stocks, for example. If all these apples represent stocks, we know that there's all kinds of stocks I can invest in. There's U.S. company stocks, there's international stocks. There may be, small company stocks, large company stocks, medium-sized companies, and things like that. So within the asset class of stocks, there's a lot of different ways to diversify. Same with bonds. In the world of bonds, there's U.S. government bonds, there's corporate bonds, there's bonds that have a long duration, there's bonds that have a short duration. So instead of just putting one bond in my diversified portfolio, I'm going to put all four types of bonds in my diversified portfolio. Instead of one type of stock, U.S. large companies, I'm also going to put international companies, and I'm also going to put, maybe small companies and not just, large companies. So you just keep adding to this portfolio mix, and you say, I want some companies, that are emerging markets, and I want some companies that are, big, and I want some that are small. So you keep adding to this bowl over here. And by the time you get done, you've got this big, beautiful bowl of all kinds of different fruit instead of just putting it in one. And when you do that, that diversifies your portfolio. What does that do? A diversified portfolio means all you've done is minimize the risk. It doesn't eliminate the risk, but it does minimize it. And it tends to smooth out the investment experience over time. That way, if oranges are not going good, your whole portfolio doesn't go down, because I've got apples and I've got lemon and I've got lime and I've got raspberries and blackberries. I've got all kinds of other things in there that are affecting the portfolio, not just oranges. And even in the world of oranges, I don't have just one type. I have all kinds of different types. That's what it means to be diversified. So the way I look at this is that there are two distinct decisions to be made when constructing a portfolio. The first one is asset allocation. That just means what percentage of your assets should be in stocks, what percentage of your assets should be in bonds and fixed income types of investments. That decision really determines your performance. The biggest indicator of your performance in a portfolio is not even diversifying, it is asset allocation. What diversification does in that portfolio is adds all the different types within those asset classes. And what does that do? That limits volatility. So the diversification has the biggest impact on volatility in a portfolio, which is what we want to have. Limited volatility for a smoother ride and better long-term results. The technical term for a measure of risk that a portfolio is taking is called standard deviation. The better your diversification, the lower your standard deviation. The lower your standard deviation, the better your portfolio is at limiting risk. If you found this video to be helpful, and I hope you have, please hit the like and subscribe button below for more content just like this. I release videos like this every 2 weeks on this channel. In fact, you won't want to miss my next video on evaluating and comparing portfolios because my fruit bowls will be back for that one too. So please don't miss it. Hit like and subscribe, and I'll see you soon.